And I agree with the President. I beg to move.
And when the chair of the Finance and Planning Committee took to the floor to defend the repeal, he would be rudely interrupted midway.
The purpose of this amendment is to save members of the public who have loans so that the interest chargeable in the loan will not be...
The President's recommendation to repeal the cap on lending rates was only saved by a tally which determined that the House lacked the requisite 233 members to overturn his recommendations.
The first step is to ascertain whether we have not less than 233 of yourselves present in the chamber before any other step.
Kiambu Town Member of Parliament Jude Njomo, the originator of the interest rate cap law, says the failure to register the required numbers reflects an abdication of responsibility to defend the will of the people.
Laws are created to provide provisions and protection to our people. So if we feel that they are going back to the habits they had in the past, where they were raising interest up to 25%, up to 30%, we can go back to the drawing board and reintroduce the capping again.
A Lagos Songa Member of Parliament and member of the Finance and Planning Committee, Sam Atandi, however, says that all is not lost for those who have been championing the retention of the cap on lending rates.
The first amendment which went through was that we were able to pass through our amendment, which gave the option that the President memo would go through, but the current loan holders would be allowed to maintain the prevailing rates. And I think that has gone through successfully. So I think as a committee we have done a bit. At least to shield Kenyans, the current loan holders, from the new rates.
After 3 years and 2 months, members of parliament have given a green light for a repeal of the law capping interest rates. At least for now, it should not be forgotten that within 6 months a similar bill can be reintroduced, and some MPs tell us they're more than ready to use that window to reintroduce capping of interest rates. Julians Amboko, NTV. Right, and that story sets the stage for our studio conversation, where we are focusing on the developments in the National Assembly yesterday, where, of course, the proposals from the President regarding the Finance Bill of 2019, and particularly on the subject of repeal of the cap lending interest rates, sailed through based on the numbers. And in studio, I'm joined by Justina Vuku from Sterling Capital, where she's a research analyst. And I have Martin Kirimi from Standard Investment Bank. Welcome to the set. And I have Sarah Wanga, Head of Research at AIB Capital. Welcome to the show. And Martin, if I could start with you, we are sitting here at a time when the market should have opened by now. And by the market, I mean the Nairobi Securities Exchange. What are some of your expectations around the banking stocks?
Exciting, because as investors started pricing in the news on potential rate cap repeal after the memorandum was sent back from Parliament, from the President. Investors started being bullish on bank stocks. And I think with yesterday's developments, that should be quite a big positive. And for the market, I think as market intermediaries, we are very excited on the developments of yesterday's developments.
Yes.
Yeah.
Before I get to Sarah, let me just stay with you for a while. Some would argue, and I've had this argument quite a bit, that we have seen a rally, and by rally I mean steady price increase in the banking stocks, ever since this memo was sent back to the National Assembly. Perhaps yesterday's expectation was already priced in by investors. Is a view that you share?
I do share that. If you notice, towards the tail end of when the Finance Committee released its report, that's when we actually saw the spike in bank stocks. So we are talking about Equity Bank north of 20%, KCB, NCBA, and the like. The view already yesterday and the day before yesterday, there was some price taking, mostly by local investors, which makes sense. If a stock is already up more than 20%, if I was on the other end, of course, I'll cash in some profits. But yesterday's development, I think they will now trigger more inflows coming in, more locals and also foreigners buying into the stock, because now a little bit of uncertainty whether it's going to pass the House, it's already out. So now we should see some gradual movement and bullish for that matter on the bank stocks, and I think that should now carry forward to even the rest of the sectors in the market, not just bank stocks only, yes.
Okay. Yeah. I should clarify that when you talk about profit taking, you mean people selling off to get their
Precisely,
money back.
yeah.
Let me get to Sarah Wanga. Your thoughts around your expectations this morning around, especially banking stocks?
I expect them to rally, mainly because, some of the information had already been priced in, but as at on Mondays, we saw some profit taking. So foreigners had bought a number of these banking stocks at relatively low prices, and they had been taking profits. So locals had bought in, but it's not yet fully priced in. So there's still some upside, and so we expect banking stocks to rally today morning.
Okay. And Justina, your initial thoughts on what to expect today?
Today I expect most banking stocks to close on the upside of 10%, not over 10. The 10% is the limit. So KCB equity, we expect them to do 10% today because the uncertainty has been lifted off. It's almost a sure bet now that the interest rate caps are coming off. So we expect banking stocks to rally today and for the rest of the week.
Okay. I want to get to Martin and talk about what this actually means now for the banking sector. For the longest while, ever since we had the interest rate caps coming into effect in August 2016, we saw banks experience a bit of contraction, not actually, I would say significant contraction in their interest rate income. And now the question now is, we saw banks entering a phase where they were becoming, if I could say, extremely efficient in terms of operations, and because it meant that they had to optimize on their revenue streams. Yeah. Do you feel this will be a loss now that we are seeing a potential reversion back to the focus on interest rate income?
Not necessarily. Actually, now I think it's more of a shot in the arm in terms of the top line. I'm looking at a scenario whereby now I'm a bank, I already increased, we already focused ruthlessly on efficiency, which we notice across the board. You notice a bit of layoffs, which is sad, but you notice a lot of cutting of excess fat by going digital and agency banking and the like. So right now, with I as a bank, or with banks now given even better margins to play with, that is on the interest income front, we should now even have a better buttressing element towards the bottom line. Mm-hmm. So I think this is actually not a reversal, it's more of a positive. And I think as bank investors, this is something they'll be very pleased about. Mm-hmm. And that's where now cherry picking of bank stocks also come into play. Over and above what you're talking about, the market as well, we also need to look at the entire banking sector. Your tier 3 banks were really in, can I say, on life support, for lack of a better word, because the efficiency levels are really north of 100%, so we're actually posting losses. So right now, I think it's actually, whatever happened yesterday is actually a big relief to them because they're really on a life support. So I think in closing, basically, this is quite a big positive. The efficiency levels already introduced earlier on, added now to the fact that now we don't have a cap on the rates, is now equals a better return on equity, which is good for investors. Yes.
Okay. Sarah, do you share these views? Because some would still contend that perhaps we'll be trading off, now we have the rate cap repealed, but the aspect of efficiency for banks, where is it left?
I believe banks will continue to be efficient. It's about increasing profitability. So when the rate cap was introduced, what they did is they realized they could no longer increase income by increasing interest rates. So they looked for other ways to increase profitability. So one of the ways was improving efficiencies, so cutting costs. Another one was increasing non-funded income. So that's income that is not related to interest rates. So they increased their fees and commissions. They went into mobile lending, and so they were able to increase profitability. Mm-hmm. So now that interest income is likely to increase as they increase borrowing, they'll still focus, profit is still the key issue for them. So they still need to be more profitable. And so we could see cost increase because they've got higher income. However, the question is which one will grow faster? So if income grows faster, then the efficiencies will still remain.
Okay.
Yeah.
Justina, your thoughts on the same?
I agree with what they've said. I think banks right now are in a very good position. They've become creative over the interest rate regime where they increase the non-funded income and they become so efficient. Now when we reintroduce a growth rate into the interest income line, now we're going to see banks that are extremely profitable right now, because they don't really have a reason to give up the efficiencies that they've already adopted. So now we're going to see a lot of progress and profitability from banks.
Okay. And the backbone of this debate around the cap on interest rate has been that SMEs, or the highly risk-perceived businesses, have been unable to access credit. And I have a question, and my question is that when you look at the asset quality, and the way we look at asset quality in banking is to look at the non-performing loans, we're at about 12% as we speak. And if you look at the scenario whereby the government is still borrowing significantly from the domestic market, the question now is, repealing the cap, will banks really still lend to SMEs? Because, I mean, if the risk is that high, because we've seen NPLs rising over time. Martin, I want to get your thoughts. Do you feel that, given our fiscal side, and by fiscal I mean government borrowing, do you still think we have room for lending to the SMEs?
Yes, we do. And I think this is where you as journalists, I'll actually put you on the spot. Because and also banks for that matter. I think the communication from banks that at the end of the day, we are not the bad guys. They are perceived to be the bad guys. And the media publishes we are back to the expensive loans. The problem is the risk profile of that SME vis-a-vis the risk profile of the risk-free government. So if on the fiscal side, we still have an aggressive fiscal policy. We want to borrow north of 300 billion on the domestic market. And on the other side, banks were capped at how much to lend to that SME who's risky. The cost of risk, we're talking about north of 5%. It doesn't make sense. But right now, the element of increasing the extra margins, if I can use, will be that SME will actually get funding, but at a slightly higher cost. We are waiting to see how big of risk adjustment, risk pricing will banks come out with, especially now with the third quarter results announcement. We want to see what will be the new risk pricing. Will the banks just put everybody in one bucket, or will we now have proper risk pricing mechanisms to make sure that a certain SME will be gauged differently from a different SME. So to answer your question is that yes, we should see now funding now trickling down to the SME, but now at a slightly higher rate, no doubt, given that on the other side, the fiscal side, government still needs money, and a lot of money for that matter, and it will be competing now with the private sector. So we'll also talk about what will have an effect on the yield curve going forward. Yes. Okay. Yeah.
And Sarah, still on the same subject, I was in Parliament yesterday, and some legislators intimated to me that beyond what you saw on the floor of the House, of course, there were backdoor conversations, and banks were really put on the spot in terms of what is the future beyond what transpired yesterday. So the question would be, we've seen legislators like Moses Kuria table a private members bill, and that was before the repeal yesterday. And the discussion was, should we have a 6% risk negotiation window for SMEs? And I'm wondering, is this now something that we can use to gauge, based on what he was saying, how high we are likely to see interest rates jumping beyond yesterday? Do you feel that SMEs would be able to access credit given how much the government is in the market?
So the problem with government borrowing from the domestic market is that it crowds out the private sector. So that means instead of banks lending to individuals, SMEs, they'd prefer to lend to the government. And even if the rate is lower, it's because government is considered to be risk-free. So when the interest rate cap was introduced, the problem was that it was only a 4% margin. So banks were comparing the interest they would get from a government bond or a T-bill vis-a-vis the lending to the private sector. Back then it was 14%. And so because of the high rates the government was offering, they would prefer to lend to the government. And so that's why lending to the SMEs reduced. However, if interest rates for government bonds reduced. What that means is that the risk adjusted, so comparing the interest rate on the T-bills and bonds versus the lending to the private sector, that's what we call risk adjusted rate. If that one increases, it makes it more attractive for banks to lend to the private sector. So it's not just about that 6%, it's about comparing what the government is borrowing at vis-a-vis what the banks can lend at.